Okay, good evening now. Like I said, tonight we'll be looking at IFRS 13, fair value measurement. And IFRS 13 fair value. IFRS 13 is just talking about how do we fair value an asset? How do we get the fair value of an asset or a liability? And from our previous discussion, where we were discussing about maybe IAS 16, maybe IAS 16, IAS 30, IAS 13, IAS 16, IAS 40, IFRS 5, amongst others, we said fair value is the price that will be received to sell an asset or to transfer an asset, or the one we will receive, the one we will use to settle or transfer a liability. Sorry, 1 minute. Okay, apologies. As I was saying, we said fair value is the price that will be received to sell an asset or transfer a liability in an orderly transaction between market participants at a measurement date. Like we said, it is the price at which what an asset will exchange hand from between two persons. If we want to take over an asset, fair value is like the price you will have to pay to buy that asset or to take over that asset. Or if you want to settle a liability, fair value is also the amount you will need to settle that liability in an orderly transaction, that is in a transaction that is not influenced by any other thing. No familiarity, no influence, nothing. Between market participants. Who are the market participants? Buyer and seller, and sometimes the regulator, at the measurement date, that is on a specific date. The fair value today may not be the fair value tomorrow, especially when the market participants now have another information at their disposal. So it is important to note that fair value is market-based measurement and not entity-based measurement. That is, when we are fair valuing an asset, we look at the whole market, not only an entity's position. We look at the entire market. That is, we consider all buyers and sellers in making that, in determining what the fair value will be. Now, and also, when we are to get fair value, we have to look at the current market condition. We have to look at what? Current market condition. Where we want to value an asset using fair value, we have to look at, are we valuing each asset as a standalone or as a group of assets? If you remember, under IS 36, when we were discussing, we said something about cash generating unit. And you realize that for cash generating units, when they are giving us the value of the cash generating unit, they used to give us for the entire group of the assets. So in that case, if you want to fair value also, the book value you have for the entire asset, the fair valuation should also be for the entire asset. And where the prices of an asset is on their standalone, we should also fair value on what? On standalone basis. However, where an asset is non-financial, And when we say non-financial asset, just like we say non-monetary asset, the valuation is premised on what? The highest and best use. The highest and what? And the best use. In determining the highest and the best use of an asset, we look at things like what? We look at three things: the physical possibility of the use of the asset, the legal permissibility for the asset, and the financial stability, financial feasibility of the asset. What do we mean by this? Physical possibility. Take for instance now, you cannot just buy a land, maybe in between residential houses now, and say you want to build filling station there. It is not physically possible, because if you build filling station, if you want to build filling station between residential apartments, one, the land itself may not even be suitable for that purpose. Two, is that what? You will be endangering the lives of those that are there. Even your own business is not safe. Or maybe you now go to, if you go to a place like, let's say, VI now, you now want to use the land you have at a place like VI, which is an urban center. You want to use it to be doing crop farming, like maybe planting of cocoa or this thing. It doesn't make any sense. Physically, it is not possible. Then the next one we look at is the legal permissibility. Is it permitted legally? Does government permit you, or does the laws of the land permit you to use the assets for such purpose? Just like I said, if in a residential area, no government or no law will permit you to use such land to do filling station, because they know the risk that is involved. But when government has marked the place that, oh, this place is for agriculture, and you want to set up a farm there, sure, they will permit you. But a plan that they have marked for agriculture, you say no, you want to build a factory there, they can deny you, because that place is not marked for such purpose. And the last one is financial feasibility. Financial feasibility in the sense that that purpose you are saying you want to use the land for, do you have the financial capacity to finance it? If all of these three are possible, then the one with the highest, the value with the highest and best use, not considering, after considering the physical possibility, the legal permissibility, and financial feasibility for the options we have, the one with the highest and best use is what we will now what? Is what will be the fair value of the asset. Now, to determine the fair value of an asset, it should be what? The fair value should be determined at the exit price. That is the price at which you will sell. The price at which what will take the asset out of the market. The price at which you will take the asset out of the market, just like we said here. Exit price. Now, but in most of the cases, the entry price, which is the transaction price, is the same thing as the exit price. Is the same thing as the exit price. But where the entry price is not the same thing as the exit price, what can be the cost? Number one is that where transaction is between related parties. What do we mean by that? If I want to buy something now for maybe a member of this class, then an element of influence will come in. Or maybe I want to sell something to a member of this class now. We know each other now. We know each other now. Do it for me at this amount. That's one of the cases where the transaction price may not be the same thing as the exit price, or where the sales is under duress, maybe the seller is in a financial difficulty. You know how some people are. They don't buy things in the normal market. They wait for where the owner has an issue. That's what they will take advantage of. Where the unit of account represented by the transaction price is different from the unit of account for the asset or liability measured at fair value. Yeah, let's take for instance now, if you stay on the island, at least I know for places like Lekki, not the market, but if you want to buy things like even pepper, yam in stores there, they don't sell based on, like yam now, they will not sell patuba or pepper, they will not just sell randomly. They will sell based on the weight. So they will tell you, okay, you want to buy this yam, they will weigh it. Oh, 50 kg. Sorry, yam cannot be as much as that. Okay, let's say 15 kg. Yes, the 15 kg, they've already put a price on per kg. That's what they will give you as a price. So, but whereas the unit of account for the transaction price is what is based on per tuber. Let's assume when they brought it into the market, at the price per tuber. But to exit the market, you are now exiting the market at price per kg. When the unit of account is not the same, then it can cause the entry price to be different from the exit price. And when the transaction take place in a market that is different from the principal or most advantageous market. So if there is difference between the transaction price, don't forget transaction price, we say that is what? The entry price, and the exit price, we know call it for the one profit.
More on the fourth line. Expatiate more on the fourth line.
Okay, I want to get to the next paragraph where I will explain principal and most advantageous market. But let me just quickly do that then. So where the transaction take place in a market that is different from the principal or most advantageous market, where do we call the principal market? The principal market is the market that has the highest volume for a transaction. It's the market that has the highest volume for a transaction. For example now, if you want to buy phone or computer gadgets, the principal market will be what? Computer village. Because we believe that in the whole of, I don't know if I will say in the whole of Nigeria, but at least let me say in the whole of Lagos, the market where the greatest volume of transactions relating to phone and computer gadgets will take place is the computer village. Yes, phone and other gadget transaction might be occurring in other places, in every other places, but the place that will have the most voluminous transactions relating to phone and other gadgets will be what? Computer village. If we want to talk of electronics and all these, electronics and all these Igbo stuff, you see most of those transactions take place where? Alaba market. If we want to talk about iron and iron transactions, most of it will take place at what? At Owode. So those are like principal markets for those kind of transactions. The market where the greatest volume of transaction takes place. And what is most advantageous market? Most advantageous market is the market is the market where is the market that will give us the highest is the market that will give us the highest benefit, or the highest benefit, where there is no principal market. Take for instance now, in some cases we may not really have a principal market. Let me say, if we want to talk of let me look for a transaction. Okay. So we cannot really say this is the place where they produce or where the greatest volume of transactions relating to bread takes place in Nigeria. Every geographical, every location, or every street, or every city has their own bakery and everything that do their bread. Are we getting it? Now we cannot really say this is where the greatest transaction of bread making or bread consumption will take place. However, when we have that kind of case, we have to determine what we call what most advantageous market. So we will not consider different market that we have for bread, with the one that will give us the highest price or the highest benefit is what we refer to as what the most advantageous market. Is it clear? Now, when a transaction does occur in the principal or most advantageous market, then it will lead to a case whereby the entry price will not be the same thing as the exit price. Do we understand that?
Yes,
Do we understand? So we also have what we call active market. Active market is just either the principal market or the most advantageous market. However, it is necessary to note that when we want to determine what is it cost? When we want to determine fair value is determined in the principal market. We have to first consider principal market. It is where we don't have principal market, we now use what? Most advantageous market. In the principal market, fair value is calculated as selling price less transport costs. Selling price less transport costs. However, even in most advantageous markets, fair value is still selling price less transport cost. However, to determine the most advantageous market, we first do selling price less transport cost less transaction cost. Selling price less transport cost less transaction cost. What are we saying in essence is that where we have a market with the greatest volume, that market automatically becomes our principal market, no problem. But where we don't have principal market, to determine most advantageous market, since we have different markets, we do what? We do selling price minus transport cost minus transaction cost. But once we determine what is our most advantageous market, based on that, the fair value will be recomputed using what? Selling price less what? Selling price less transport costs. So what are transaction costs? They are just those costs. That we incur in the market, like agent fee, commission, amongst other things. Like I said, market participants are what? Independent buyer and seller who are what? Well informed and willing and able to enter into a business transaction. Their characteristics are what? One, they are independent of each other. That is, they are not related, no influence whatsoever. They must be knowledgeable. You must have a knowledge about the market. Number three is that what? They have the capacity to enter into transactions for asset or liability. You know, there are some people that cannot enter into transactions like minor or a convict, or someone that is of unsound mind. People like that now. Okay. Sorry. Okay, so as I was saying, we have what? They must be willing to enter into transaction and not forced. Now, for prices to be based on orderly transaction, two things must be present. One, there must be adequate market exposure. That is, those market participants, both the seller and the buyer, must have enough knowledge and awareness about the asset or liability. And two, they are willing and motivated to carry out the activity, not forced to do so. Not forced to what? Not forced to do so. That is that. Now, so how do we, what's the valuation technique for IFRS 13? Why we use valuation technique to establish price is what? Is to make sure that what? We is to make sure we are able to get price at the current market date. Now, we must ensure, organization must ensure the what? They maximize the use of relevant observable inputs and minimize the use of unobservable inputs. What are observable inputs? Observable inputs are those inputs that are readily available and have less less and which the organization have less control over. Things like maybe um published account, information on stock exchange markets, amongst others. While unobservable inputs are those ones that are estimate or prediction of the organization itself. So we have three approach. We have market approach. Market approach is where we use the price of similar or identical assets and liability. We have cost approach. That is where we use the cost that will be required to replace the asset today in getting the fair value. While we can also use income approach. Income approach is where we look at what is the future benefit we are expecting to generate from the use of this asset, and we discount it back to today's term to determine what will be the fair value of an asset. But we use whichever of this approach, but the one that has sufficient data. We use the one with sufficient data that can enable us maximize the use of observable input and reduce the use of unobservable input. That is that. So what are these inputs we are talking about? We have level 1 input, we have level 2 input, and we have level 3 inputs. Level 1 inputs are what? They are quoted prices. Quoted prices that are unadjusted for risk premium or discount in active market for identical assets or liabilities that an entity can access at the measurement date. So what do we mean by that? Take for instance now, if we want to fair value maybe the stock, the shares of an entity, a level 1 input for such will be the what? The price, or yes, the price quoted on stock exchange market, because that one is a level 1 input. It is what? It is unadjusted for risk premium or what? Or discount. NGX would have quoted the price as what it will be without tampering with it or anything. But and level 1 input are the most reliable evidence that we can use for fair valuation. But for level 2 input, they are also quoted prices, but they have been what? They have been a bit tampered with. What do we mean by that? The level 2 input will be maybe the price at which it can be sold in the market. Then we now consider maybe the current economy, maybe a future expectation from the economy and things like that. While level 3 inputs are unobservable inputs, and they are what? They are developed by the organization when they are unable to get level 1 or level 2 inputs. Do we understand? Do we understand? Okay. Let's look at. Okay, let's start with question 3. Who will read for us? Question 3. Question 3.
Brainfield has an asset that can be sold into different active markets at different prices. It enters into transaction in both markets, obtain the following prices at the measurement date. Number one, the selling price of the asset was 40 million in the market A and 38 million in market B. Number two, the legal fee incurred were 2 million and 1.8 million in market A and B respectively. Three, the valuation fee were 3.5 million and 1 million respectively for the cost of delivering the asset to the market were 3 and 4 million. Determine A, market A is the principal market, B, and the market is the principal market.
Okay. Thank you. So in this question, we've been given information about an asset that Brainfield want to sell, and they've given us information about the market. We are now to determine the fair value. If market A is the principal market, what do we have? We just have what? IFRS 13 fair value measurements. What is the fair value measurements we have? One, so we are looking at question 3, Brainfield. So if market A is principal market, remember what we said, where we have principal market, fair value will just be what? Fair value will be equals to, in market A, what is the selling price? I'm coming. Then fair value will be selling price how much in market A?
40 million.
40 million. Less transport cost. What's the transport cost?
4 million.
4 million. So with that, the fair value will be what? 36 million. That's just all we want to do there. That is just all.
That's all.
Yes. Yes, sir. But if neither market is a principal market, if neither market is a principal market, then what do? Then we have to first determine most advantageous market. Then determine most advantageous market. Most advantageous market. What is our most advantageous market? To do that, we'll create column for market A, market B. Selling price, which is how much? 40 million in market A, and what? 38 million in market B. Less transport costs, which is 4 million in market A, 3 million in market B. Then less transaction costs. Transaction cost. What are the transaction costs? Legal fee. Legal fee, which is how much? 2 million in market A, 1.8 million in market B. 1.8 million in market B. Then what else do we have? Valuation fee. Valuation fee, which is what? 3.5 million in market A and 1 million in market B. With that, what do we have as the price?
Market A, 30.5.
30.5. What about market B?
32.5.
32.5. So which one will be our most advantageous market? Market B, because it gives us a value higher than that of market A. However, if market B is the most advantageous market, then fair value will be what? The fair value in that market B will now be what? Selling price, which is how much? 38 million less transport cost. Less transport cost. How much? 3 million. And that will give us how much? 35 million. That means if we are to use most advantageous market, the fair value is 35 million. But if we are using principal market, where A is principal market, then fair value will be 36 million. Do we understand? Do we understand?
Sorry, Mr. Good, that B is 32.2, not point.
As I'm doing, there's 2.2.
Don't worry, don't fight. 32.2 is still greater than 30.5. Don't worry, Kendi, I will not beat you for it. Question 4. Who is reading?
Okay, question 4. Yanong owns several farms.
You cannot see it.
Okay, I can see it now. Yanong owns several farms and also owns a division which sells agricultural vehicles. It is considering selling this agricultural retail division and wishes to measure the fair value of the inventory of vehicles for the purpose of the sales. Three markets currently exist for the vehicles. Yanong has transacted regularly in all three markets. At 30th April 2015, Yanong wishes to find the fair value of 150 new vehicles, which are identical. The current volume and price in the three markets are as follows. All figures that seem to be correct. Yanong wishes to value the vehicle at $39,100 per vehicle, as these are the highest net proceeds per vehicle, and Europe is the largest market for Yanong products. Yanong would like advice as to whether this valuation will be acceptable under IFRS 13 fair value measurements.
Okay. So Yanong wants to know. They want to value their 150 vehicle and they've calculated the value to be 39,100 per vehicle. But they want to be sure if what that 39,100 they are calculating per vehicle is right or wrong. We have three markets: Europe, Asia, and Africa. And we have the sales price per vehicle in that market. We have the volume sales in each of the market to be 6,000, 25, and 15. We have the volume sold by Yanong in that market to be 150,000, 750,000, and 100,000. We have the transaction cost per vehicle, and we have the transport cost to market per vehicle. So, what do we do? Since they already told us that Europe is the largest market for Yanong's products, and we already see here that the highest volume of sales in the market occurs in Europe, then we can conclusively say that question 4 A. The principal market for Yanong's products is Europe, and the fair value per vehicle will be selling price. How much is the selling price? 40,000 is the selling price in that market. Less transport cost. How much? 400. And that will give us how much? 39,600. That is the right market fair value per vehicle, 39,600. Why they are 39,100 was because they deducted transaction cost of 500. But don't forget, we only less transaction cost to determine what is the most advantageous market. We don't deduct transaction cost to determine fair value. Is it clear? Is it clear?
Yes, sir.
So
Yes,
they now do the total fair value for the 150 vehicles. It will just be what? 39,600 per vehicle multiplied by 150. And that will give us how much? Five
5
million nine
million now,
forty
John.
thousand. So this is what they should recognize in their statement of financial position as a cost of that of those inventory. Sorry, that's what they should recognize as the market value for those items. But if it's inventory, they have to consider compare lower of cost and net realizable value. For B, who is reading? B, who is reading?
Inogua used the revaluation model for its non-current assets. Inogua has several plots of farmlands which are unproductive. The company feel that the land will have more value if it were used for residential purpose. There are several potential purchasers for the land, but planting permission are not yet been granted for use of the land for residential purpose. However, primarily the required with the regulatory authority seems to indicate the planning permission may be granted. Additionally, the government are recently indicated that more agricultural land should be used for residential purpose. Inugua has also been approached to sell the land for commercial development at a high price than that of residential purpose. Inugua would like to advise on how to measure the fair value of the land in financial statements.
Okay, if we look at it, this is a non-financial asset. And how do we measure the fair value? We said it's the highest and best use, where there is what? Physical possibility, legal permissibility, and financial feasibility. So first thing first, if we look at the land yarn on gas, they said what? They can use it for, it is a farmland, but they are thinking it will have more value if they use it for residential purpose. Though they haven't gotten planning permission, that means it is not legally, what's it called? Legally permissible yet. But the discussion they have with the regulatory authority said that indicate that their planning permission may be granted. However, the government officials, government has already indicated that they want more agricultural land to be used for residential purpose. So if we look at this, we can say it is highly probable that the planning permission will be granted. And also, some people has approached them to sell the land for commercial development at a price higher than that of residential. Now, do they have the legal permissibility to use that land for commercial purpose? No, they did not tell us anything about that. So in this case, how should they measure the fair value? The fair value should be measured at residential, as if the land is used for residential purpose. Why? Because for residential purpose, they have what? They have the financial, it is financially feasible. It's financially feasible that they will be able to build it. Number two is that what? It is legally permissible. They are almost about to acquire, get the planning permission. And also it is physically possible to use that land for residential purpose. So the fair value of the land should be based on the residential purpose. Can we look at question? These questions are much. Oh, sure, I will not want to be like this. Okay, I'll just take one and then someone else will take the remainder. So let me take question one. What do we have there? Who is reading? We have MERA, a public limited company. We have MERA, a public limited company, has just acquired a company which comprises a farming and mining business. MERA wishes advice on how to value some of the assets acquired. One such asset is a piece of land which is currently used for farming. The fair value of the land, if used for farming, is 5 million. If the land is used for farming purpose, a tax credit currently arises annually, which is based upon the lower of 15% of the fair market value of the land, or 500,000 at the current tax rate. The current tax rate in the jurisdiction is 20%. MERA has determined that market participants would consider that the land would have an alternative use for residential purposes. The fair value of the land for residential purpose before associated cost is ought to be 7.4 million. In order to transform the land from farming to residential use, there will be legal cost of 200,000, a viability analysis cost of 300,000, and cost of demolition of the farm of 100,000. Additionally, permission for residential use has not been formally given by the legal authority, and because of this, market participants have indicated that the fair value of the land above the cost will be discounted by 20% because of the risk of not obtaining planning permission. In addition, MERA has acquired a brand name associated with the produce from the farm. MERA has decided to discontinue the brand on the assumption that it will gain increased revenue from its own brand. MERA has determined that if it ceases to use the brand, then the indirect benefit will be 20 million. If it continues to use the brand, then the direct benefit will be what? 17 million. So what do we have to say? Does anyone have anything to say? Question one. So what do we do here? We are looking for the highest and best use of the asset. Highest and best use of the asset. So to get the highest and best use, we have, if the land is used for farmland purpose, farmland, which is what they are currently using it for, we don't have issues. For them to be currently using it as farmland, that means it is physically possible, it is legally permissible, and it is financially feasible. So for that, they said what? They said the fair value of the land, if used for farming, is 5 million. Fair value, 5 million. Then what else? They said if they use it for farming purpose, a tax credit currently arises annually, which is based upon lower of the what? 15% of market value of the land. Okay. So if they will enjoy a tax credit, they said they will enjoy on lower of, so let me do it this way. fair value 5 million less tax credit. What is the tax credit? Lower of what? 15% of the fair value. We'll have 15% of the fair value or 20% of 500,000. He said 500,000 at the tax rate, at the current tax rate, and current tax rate is 20%. The 500,000 is the tax distance. So that will give us how much? 100,000, Abi. Then 15% of 5 million would have given us how much? Hmm. Do I still have people on this call? Do I still have people on this call? 750.
750,000.
So the
750,000.
lower of the two is 100,000. That means the fair value for farmland is what? 4.9 million. The next one we have, the next use we have for the asset is residential. Residential, they've told us that the market participants are considering it for residential purpose. And the fair value is what? The fair value they are putting on it is 7.4 million. Then they said what? But they will need to transform the land from farming to residential use. And for that, there will be legal costs. For that, there will be legal costs, viability analysis cost, and cost of demolition. But the planning permission is yet to be received. Abi? So they said that what? Market participants are indicated that the fair value of the land after the above cost. So we'll say less legal cost, $200,000, viability analysis cost, viability analysis 300, then demolition cost 100. Okay, so that will give us how much? This is 6. So that should give us 6,800,000, Abi. 6,800,000. So discount on the land. Discount on the land value will be what? 20%. 20% of 6,800,000. So what do we have as 60%? 20% of 6.8 million.
That's 1,360,000.
1,360,000. So if we want to get the fair value for residential, fair value will be what? Fair value, or let me say selling price. Selling price. The selling price will actually be what? Selling price selling prices 7.4 million less discount, which is 1,360,000. Okay, so what do we have as summation? $6040. Then the last one, they said, okay, that one is about a brand. So if we look at this now, the highest and best use of this asset, the highest and best use of the land is to take it to be what? Is to take it as residential place, so that the asset can only collect 4 million. Okay, so what do we do? The fair value of the land, therefore, value of land is 6,040,000. 6,040,000. In relation to branding, they said what? They said they have determined that if they cease to use the brand, the indirect benefits will be 20 million. But if they continue to use the brand, the direct benefits will be 17 million. They've decided to discontinue it. So the fair value on it should be what? Should be 20 million. Now, number next, they said Mirror wishes to value the inventory of the entity acquired. There are 3 different markets for the produce, which are mainly vegetables. The first is the local domestic market, where Mirror can directly sell to retailers. Sorry, this is the first. The first is the local domestic market, where Mirror can sell directly to retailers of the produce. The second domestic market is one where Mirror sells directly to manufacturers of canned vegetables. There are no restrictions on the sale of produce in entire of the domestic market order, other than the demand of the retailers and manufacturers. The final market is the export market, but the government limits the amount of produce which can be exported. Mirror needs a license from the government to export produce. Farmers tend to have to sell all of the product they can in the export market, and when they do not have any further authorization to export, sell something, and they sell the remaining produce in the 2 domestic markets. It is difficult to obtain information on the volume of trade in domestic markets where the produce is sold locally directly to retailers. But Mirror feels that the market is at least as large as the domestic market direct to manufacturers. The volume of sales quoted below have been taken from trade journals. We have the volume sold in direct to retailers, volume sold in direct to manufacturers, and volume sold in export market. So they've told us that okay, so we have the sales per month for Mirror, we have the price per ton, we have the transport cost, and we have the selling agent fees. Since they've told us that it is sorry, I'm trying to check something. They told us that they sell all of their products, all of the produce they can sell in the export market. And when they do not have any further authorization to export, that's when they now sell to domestic market. That's when they now sell to domestic market. But if we look at it very well, Melon's sales per Melon's this thing has dropped. So the first thing we have to determine here is they did not tell us with what they sold, with what they told us. They told us that it's difficult to obtain information of trade in the domestic market where the product is sold locally directed to retailers. They don't know what it is difficult for them to know what the volume here is. But they are saying that they feel that the market is at least as large as domestic market. That is this thing, the volume will be the same. So in this case now, they did not tell us what the principal market is. And the most advantageous market, we've also not been able to know because they told us the volume in the direct to retailers market might be the same as the volume in the director to boomers. So what do? We have to calculate most advantageous market. Most advantageous market will be what? We have direct to retailers, direct to manufacturers, and export markets. Okay, for direct to retailers, selling price is how much? Selling price is 1,000. Direct to manufacturer, 800. And export market, 100. Sorry, it should be 1, 2.
Get 1, 2.
Should be 1, 2. Then the next thing is what? Less transport cost. What is the transport cost? 50, 70, then 100. Then with less transaction cost. We have none here, we have 4 here, we have 6 here. So what do we have as the net price for each market?
Exports 1306.
1306K. You are deducting the 100 though. That should be 1094. Abi? This should be 726. And this should be 950. And based on all of this, the most advantageous market is the export market. However, fair value in that market will be what? The selling price in that most advantageous market. Selling price, which is 1,200, less transport cost. $1,100 is what should be the fair value. Do we understand? We understand? Next one, they said Mira owns a non-controlling interest in Eram, a private company, and wishes to fair value it as a financial year end of 31 March 2016. Mera acquired the ordinary shares interest in Eram on 1st April 2014. During the current financial year, Eram has issued further equity capital through issue of preference shares to a venture capital fund. As a result of the preference share issued, the venture capital fund now holds a controlling interest in Eram. The terms of the preference share include the voting rights are similar, including the voting rights are similar to those of the company, those of the ordinary shares, except that the preference shares have a cumulative fixed dividend entitlement for a period of 4 years, and the preference share rank ahead of the ordinary share upon the liquidation of ERA. The transaction price okay, so they said the transaction price for the preference share was $15 per share. Mera wishes to know the factors which should be taken into account in measuring the fair value of their holding in the ordinary shares of ERA as at 31 March using a market-based approach. So what are those things they will need to be looking out for? They need to know what is the price per share in the market since they are using market-based approach, and they need to know cost of the cost of those things in the market. If you go through the material, you'll get what you need for this. For this, let's quickly look at 2B. I think that's the oh shoot, this thing is too much. Okay, 2B, they said one of the companies formerly operating in Nigeria that are recently relocated to its operation to Ghana as a result of challenging business environment in Nigeria has access to both Lagos and Accra markets for its product. The product sells at slightly different prices in Naira in the two active markets. An entity enters into transaction in both markets and can assess the price in those markets for the product at the measurement date. What do they want us to do? They want us to briefly explain principal market, which we have done. And we have to determine what fair value will be used to measure the sale of the above product if Lagos market were the principal market. If Lagos market was the principal market, we just say question 2. If Lagos market is principal market, then fair value will be what? Selling price, which is how much? 260. Less transport cost. So what is the transport cost?
30.
Transport cost is 20. Oh. So that will give us what? 240. 240 will be this thing. They now said how is fair value determined in the absence of principal market, and what fair value will be used to measure the sale of the above product if no principal market could be identified. I already know where there is no principal market. What do? We do the most advantageous market. If no principal market exists, most advantageous market will be what? We have Lagos and we have Accra. Selling price will be what? 260,
Somebody,
250.
Sir John reasons.
Huh? Transaction cost. Are you talking to me? Transport cost. So this is 220, while this is 210. So what do we have? Therefore, fair value will be what? Selling price. We'll now be using Accra market information because that's the most advantageous market. Selling price, which is what? 250 less transport cost. Transport cost of 220. Sorry, transport cost is 20. So the fair value will be 230 per unit. So I think this is relating to the other one we did the other time. So I think that will be all. That will be all. That will be all. Do we have any question?
No, sir.
Okay. Thank you very much for
No.
your time. Thank you very much for your time. Have a good night rest and enjoy the rest of your evening. Someone has a question.